Welcome to Stocks in Translation, Yahoo Finance's video podcast that cuts through the market mayhem, the noisy numbers, and hyperbole to give you the information you need to make the right trade for your portfolio. I'm Jared Blickery, your host, and back with me is the voice of the people, Sydney Freed, who's here to ask the people's questions and make sure that we don't veer off too far into jargon land. First, please like, subscribe, and comment on Stocks in Translation on Spotify, Apple Music, Amazon, or YouTube. And today, we're going to be talking about geopolitics, AI, rock and roll. What a trinity. Our phrase of the day relates to the Fed. It is policy error. That's a Federal Reserve mistake. Is a rate cut in July or by year end the wrong move? And what does this mean for bonds? And this episode is brought to you by the number 50%. That's how much leading companies using AI are expected to slash their costs by 2027, what this deflationary force means for the U.S. economy and the tech trade. And today we are welcoming Luke Lloyd, President and CEO of Lloyd Financial Group. He's built a reputation on dissecting macro events and bucking some pretty big consensus trades. And we're going to dive into the details of all of that today. First, let's get your big picture view of all the geopolitical events that are going on, kind of what's happening in the markets, and then we're going to dig into our phrase of the day.
Well, first of all, why is it always 100 degrees in New York when I come? It's like just me in the summertime. Like I can't even get around New York without coming to these things and completely looking like I just took a bath, right?
This is a bad couple of days for that.
But talking about geopolitics, it's heating up, talking about the heat, right? And a lot of news came out over the weekend that we need to pay attention to. If you know, it's funny, I sent you, I think, notes on, what was it, Thursday or Friday, about kind of some of my takes on the world. And I said that this was the calm before the storm, the two-week pause. We talked about the two-week pause all week last week, right? With the holiday and Juneteenth and everything. And we saw over the weekend the fact that we did get involved. The United States, the storm came, and we got involved, and we bombed 3 of their nuclear facilities. And that changes a lot of things, because I wrote about in my newsletter, I talk about it all the time, that, you know, this Strait of Hormuz down in Iran, in the Middle East, that's where all the exports of oil go through. So I know you're sitting here kind of to explain what all this means, but when you're shipping oil through and that gets blocked, that decreases the supply of oil. And it's interesting, when we take a look at, you know, countries, China's buying 20% of their oil from Iran, and Iran's actually exporting 80% of their oil that they produce over to China. So what this does, if you look back to the markets back in March and April of this year, we saw the market decline because of kind of bad tensions between the United States and China. All this does with the U.S. getting involved is tick off China with the United States. So this could hinder maybe some of those negotiations, whether it's tariffs or other kind of things that may happen with the rare earth deal that we had with China. If we start to see negative news around U.S. and China relations, that's going to really impact the stock market.
And let's kind of relate this to what the Federal Reserve might be doing here in the U.S., and that's what our phrase of the day is about. It's policy error. Yep. And this is a misstep by either central bankers or governments, and we're really talking about central bankers here, but they could be raising rates too far, they could be overspending, and this unintentionally derails growth, jobs, or price stability. And we've seen a lot of policy errors, not only by the Fed, but the government before. 2020 hindsight is always a thing, but how do you see the current markets? How do you see the Fed reacting to all of this?
Well, it's interesting. Everyone on Wall Street, all of the Main Street economists would say these geopolitical tensions are going to increase the cost of oil, and the cost of oil going up means that you're going to pay more at the gas pump. That means that all of your price inputs to everything that's manufactured here in the United States is going to go up. Everyone will say it's inflationary, and people would say that the Federal Reserve should maintain higher rates because these geopolitical events are inflationary. I'm on the opposite camp. I always like to be contrarian. I think that what's going on, whether it's tariffs, whether it's geopolitical events causing uncertainty, when the gas prices go up, what do people do? They might drive a little less. When the prices go up, they buy less of it. We're at a point where middle-class America, no matter what the Fed says, how disconnected they are and kind of arrogant they are, they don't understand what I don't think what Main Street's going through. So when you actually have tariffs, geopolitical events that cause uncertainty, it decreases spending in the economy, and that is all disinflationary and deflationary. So you ask the question, when should the Federal Reserve cut? My opinion, 6 months ago. But they are still late to the game. Just like they were late to the game on the way up, they're going to be late to the game on the way down.
I want to just back up and talk about the conflict in the Middle East for a second. How does an average investor think about what's going on there? Are there changes people need to be making to their portfolio? Should you kind of ignore it? How do you proceed?
I think you do want to own some of those energy stocks, not only just the oil stocks, but liquid natural gas. We talk about the energy transition. I'm sure we'll talk about a little bit about AI today.
Sure.
But there's so many tailwinds going on, whether it's geopolitical events through the Strait of Hormuz, whether it's AI, whether it's the fact that it is 100 degrees in New York right now, and you have all this kind of heat waves. There are heat waves going on in Europe and America right now. All of that is demand for commodities. So if you want to play the commodities going up, own ExxonMobil, own Cheniere Energy that has a lot of their liquid natural gas production through there. You want to own that. Also, obviously, I've been pretty outspoken for a while now. You do want to own some defense stocks. And when I say defense stocks, not defensive stocks.
Right. Critical distinction there.
Utilities could be a play, even though that's defensive. But I'm seeing actual, Lockheed Martin, Raytheons of the world. My clients own Lockheed just because the balance sheet looks a little bit better, in my opinion, than some of the other defense names. But, Lockheed makes the F-35s that we talk about every day. It seems like now because of the geopolitics, you want to own energy and you want to own defense names.
Well, it's interesting because defensive ITAs and not defensive, defense and aerospace ETFs, one in particular, ITA, was making record highs day after day for almost a month, maybe longer. But I want to get back to energy too, because energy was a leading sector in 2022 when we had that terrible bear market. That was the one sector that we saw strength in. Is that kind of a defensive play as well? And like how you mentioned some names here, but would you just buy a broad swath like an ETF?
Yeah.
Would you try and pick some of those names?
I think owning ETFs make a lot of sense when you have a really good feeling about certain sectors, right? For example, utilities. I briefly talked about that, brought that in equation, but like my clients own XLU, right? So it tracks all the utility sector because of AI demand, because of commodity prices rising, because of electrification of essentially everything. So yeah, I think the ETFs make a lot of sense. I think it's good to spread through stock picks and actually look at some individual names and see how they differentiate themselves. So yeah, I think that overall energy is going to be the spot. You can own it through ETFs, a collection of stocks, but if you want to get a little spicy, which I like to get spicy sometimes, right? And that's why my clients pay me, is to try to pick, maybe the individual names I think will actually do better. You can do that as well.
If you're a passive investor, though, because this is what I was trying to get at, do you need to make these changes or do you just let it ride? Should all passive investors?
If you're in,
This is a great question.
Or like,
S&P 500.
is this the entry point? You say, oh, actually, I should have exposure to energy, and this is actually a good entry point.
That's a great question, and that's a conversation we could probably talk about for hours. So we've been bailing things out in the world ever since the Federal Reserve was created. I'm not blaming directly the Federal Reserve, but we can bring in the fact that it was created in 1913, controlling demand in the economy.
We're going to talk about Jekyll Island
We
here?
can talk about 1971, getting off the gold standard. So
I just talked about that today.
Anytime something goes wrong, the government just seems to be there to bail everything out or break things, like the Federal Reserve System, in my opinion, is doing right now. So when you talk about passive investing, why is passive done so well? Well, of course, when you create the Ponzi scheme and keep the Ponzi going, everything's going to inflate, right? So what you've seen in the past, really, since 2008, 2009 especially, is a huge wealth separation. The rich keep getting richer. The middle class separates, so you either partake in the owning assets and you become the upper class, or you stay in the lower class, right? So that wealth separation, in my opinion, will continue to happen. So yes, if you're talking about 10, 20, or 30-year time horizon, passive investing will do well. The problem is for my clients that are 65, 70, 75, 80 years old that can't take a 30 or 40% correction in the market at this point when they're withdrawing money, those are the people that I'm worried about. Because in my opinion, we talked about what happened in March and April, 20% in 2 weeks. I think that could still be on the horizon. And in my opinion, there will come a point in time when we pay for all the debt issues, trillions of dollars in stimulus we printed for 4 years, and you will probably see a 30 or 40, maybe even 50% decline in the stock market in the next decade.
Let me ask you about bonds, because those were a terrible hedge in 2022, the market we were just talking about, that bad bear market. And in fact, I think it was a 2-year, they had their worst 2-year stretch in maybe a century, something along those lines. And so we've talked with a lot of guests about the potential death of 60-40. We are now in a higher interest rate regime. It seems like rates are trending higher on the long term instead of lower, as they did for 40 years. So is this a new playbook? Do bonds have a part in these portfolios that you're talking to your clients who are 65 and need some income?
I love this question because it talks about what we were just talking about, the Ponzi debt scheme going on. We saw debt downgrades happen in the United States, I think for Moody's a few weeks ago. I wouldn't be surprised if we lose the AAA rating here in the United States because of all the deficits that we have in America. And a lot of countries are dumping our debt, right? The treasuries bonds that maybe China, Russia, all these different other countries own of the United States. I think 60 or 70%, if I'm not mistaken, of our debt is owned by other countries, right? So if you have that kind of risk, then you would think that inflation or the interest rates on the debt would go up, which would be bad for longer duration treasuries, longer duration bonds. But I'm in the camp that the only solution to all of this to make sure that we don't go through a 50% correction, or if we do, what the solution will be afterwards, is they're just going to bail things out again. So the only way this economy functions, whether you're middle class or upper class, lower class, borrowing cars, mortgages, the average family can't afford it takes $130,000 to afford the average home in America. The average household income is $80,000, or median income is $83,000. So there's so much of a disconnection that this economy cannot function at these rates, including the government needs to refinance 50% of their debt in the next couple of years at higher rates, assuming it stays. So this can't function. Rates have to go lower, which is why I'm very bullish on long duration treasuries. And I think it could be a great equity replacement. If the equity markets are down, long duration treasuries will rise.
But, excuse me. So long duration treasuries rise. So we're talking about 30-year
TLT.
Yep. TLT.
Is what
All
I'm
right.
finding, so.
Interesting, because we saw the 5% in the 30-year as kind of a top several times.
That's right.
And we saw some swift declines. But I would say the 30-year is still kind of there, right close to 5%. So we haven't seen that big decline yet. What's the trigger? Does it take more geopolitical tensions? Where do we get that catalyst?
The trigger is that we actually go through some pain when it comes to the unemployment rate. So in my opinion, the trigger will actually be from AI, which I think we'll talk about here.
Oh, in a minute, yes.
So I think AI is going to be the trigger for deflationary pressure, which we'll get into. But I think that's going to be the trigger that's going to cause unemployment to systematically rise in the economy. And is this going to happen this year, next year, or next 2 years? I don't know the exact answer to that, but I have a really good feeling it's going to be within the next 3 years at some point. We're going to see unemployment tick up. That's going to crack the labor market. That's going to crack consumer spending. Debt issues will come. Well, that's when we'll lower Federal Reserve interest rates, and that's when we see the 10-year probably go back down to 3.5, or I'm sorry, the 10-year go back down to 3.5%, and probably the 30-year go back down to 4, which you can make probably 30 or 40% on your money on TLT, long duration bonds, if that happens.
I just want to wrap this part of the question, the part of the interview, with going back to the Fed rate cuts. Is it that big of a deal if the Fed cuts in July versus September?
No.
Okay.
The Federal Reserve already lost full control of the free market. So if you remember the jumbo rate cut we got, 50 basis points, what was it, like 6-7 months ago?
Sure.
I think like November, December of last year.
Kind of a surprise.
I was very surprised actually by that, because I was very outspoken that they were only going to do 25 because they lost so much credibility during the rate hiking cycle. But if you remember that, they cut 50 basis points, rates went up. So they cut rates.
Yeah,
interest rates went up because
it was actually kind of mind-blowing to watch that. And we've talked about that on this show as well. Hold that thought. We want to get to AI and deflation. We need to take a short break, but coming up, we're going to be talking about, guess what? AI deflation and a musical runway battle for all you guitar heroes. This episode is brought to you by the number 50%. That is how much AI leaders are expected to cut their costs by 2027, according to a BCG survey of 1,000 C-suite and senior executives from over 20 sectors and 59 countries. And that might argue for the future deflationary forces of AI as companies slash costs. But so far, results are minimal, with only about 4% of companies developing cutting-edge AI capabilities that consistently generate significant value. So I guess the bottom line here is we see the potential in AI, and those who are doing it are using it to great effect, but we haven't seen that uptake yet. And so this is all a guess of when, how long is the runway and how steep is it, or how steep is the decline?
Well, you're actually seeing the complete opposite of the use of AI replacing jobs, because you have to create jobs to implement AI. So that's one of the reasons, in my opinion, the job market's been so strong, is you need to hire more people to help implement the process. And what people don't understand is they're actually shooting themselves in the foot. They're the ones implementing the processes in AI, and they're the ones that are going to be replaced.
But some people need to be retrained, though. It's not like the person who might be losing their job can just go manage AI. That's a huge step.
I use AI every single day.
Well, so do I, my friend.
I would say 40, 60 hours a week.
But what? Like
Productivity.
ChatGPT?
Of course. Yeah.
But that doesn't take a lot of skill to work. Or
So maybe that's the argument.
Yeah, I don't know. I think
or clipping, like
Yes.
what we're doing right now. I use a software out there that clips all my videos. So, we'll talk about me starting this business up. It's been a couple
Sure.
months of starting this up. And if I didn't have AI, do you know how much more my costs would be? I would have to hire people to clip my videos. I would have to hire people to do maybe my newsletter that I can do now myself because I'm able to use AI to write the news at least, and then be able to go in there and actually put my takes in there. But I can have it regurgitate the news of the day instead of me looking at every single article and taking the macro data, right? So my point is ChatGPT, all the different softwares, it's going to increase productivity so much that you're going to see this wealth transition that we just talked about in the last segment. We're going to see this wealth transition increase even more. So the rich are going to get even richer because the productivity will go up, margins will actually decrease, with the cost of doing business. So why wouldn't someone want to decrease their margins because AI is able to replace some people at least, right?
Now, you talked about the labor market cracking, though. So you do expect to see job losses based on AI.
I do.
And that is the Deflationary Act. But tell me, because you're saying that AI requires more people to help implement it, so where and when does this timeline of decreased jobs play out?
So if we go back probably in the past 2 years, we didn't really think about AI too much until probably 23. And then really 24 was like kind of the year of AI and NVIDIA and everything. I think we are close to the point where almost every small business, large corporation has probably tuned up their process. So I'm thinking this is probably going to hit towards the end of maybe next year. So we have probably one more year
Before layoffs.
big layoffs. We've already seen big layoffs. I'm saying like a systematic shift where it actually shows up in the overall data. Because I think what's happening right now is when a bit larger corporations are laying people off, or even small businesses, there's enough positions open that someone can lose their job and then go find something else.
Well, that's the issue, is that people are not being hired now. It's not necessarily that we're
starting
seeing
to close up.
Yeah.
So I think that lag effect will have about another year of lagging, and then we'll see it actually reflect in the Federal Reserve data. And that's where they're going to panic a little bit.
I feel like right now, though, the products for like personal use, it's chatbot, it's ChatGPT and all those. When are we going to see other products that are meant for like your personal life and not your? It seems like everything is for your work life right now.
You talking about laundry, or
I don't know,
I mean-
but I also when you're saying everything you said, I'm picturing Wall-E and us living like
Honestly,
in a world.
OpenAI does everything for me.
It
I mean, it
does.
creates images for me. It creates taglines, headlines, social media posts.
But it's not going to penetrate the physical world until you match it with robotics, and I think that is a ways off.
that is probably a decade away. We're not going to have what's called Jarvis, like on Iron Man.
And like iRobot. the
Exactly.
movie.
We're not going to have that for a
Okay.
decade, but I think that's going to be to the point where it almost becomes bubble-ish. Like and we're approaching where, there's so much demand for AI that some sectors and things you can think about is it too much? Is it gone too far too quick with maybe future earnings growth? But when we start having robots and stuff, I mean, there comes a point when you need actually people working and enough resources for middle class America to buy this stuff. And if you have systematic job loss where unemployment goes from a healthy rate of 4.5% to 6%, 7%. There's not enough people to buy some of these goods. So it's going to stifle innovation. We're going to get to the point where one day AI is going to slow down because people can't afford the products itself.
Interesting. Now, I want to ask you, we got to move on to another segment after this, but how do you play this? Do you think that the big AI plays right now, are they the hyperscalers? Are they investing too much in CapEx? Is NVIDIA already in a bubble? Has it popped? Like, what do you think about the AI trend?
So I don't own currently right now. I don't own, and my clients don't own the NVIDIAs and AMDs of the world. We own the implementation area still because of the kind of lag effect we talked about. Accenture, I think we just saw that sell off, I think 8 or 9% last Friday. They're a consulting firm. So every one small business, large corporations are calling Accenture to help implement some of their AI processes. So we're playing the implementation play. I think you can play it also in maybe the healthcare space if you want to get more defensive with AI. We haven't seen talking about maybe some more of the actual robotics or the other side of AI. You're going to see that pop up a lot more in the healthcare space, and everything can be used around AI, whether it's medicine like drug products or whether it's actual, the robotics doing surgeries, things like that. So I think you can play it right now through the consulting companies and implementation areas in healthcare.
Excellent. Now we got to pivot. Time for Who Wore It Better macro battle of the bands. On the left catwalk with a baton in hand stands the yield curve conductor, channeling all the strength of a bond vigilante. This maestro of long duration treasuries sets a slow, deep groove, flattening or steepening the yield curve whenever rate policy drifts off key. One downstroke on the 30-year and yields drop like a baseline, warning the Fed that a policy error will not stay hidden in the mix. And on the right catwalk, in saunters the Guitar Hero, an AI-powered shredder ripping spontaneous riffs that slice payrolls, crush costs, and send sticker prices south. Every power chord slices off another sliver of CPI, suggesting that automation can inflation into a full-on deflationary solo. So, Luke, which soundtrack are you feeling here?
Pink Floyd, welcome to the machine, baby. Because we're all living in the machine. Right?
Love it.
And this actually applies to everything we were just talking about. And I like to shred. So that's where we're talking about this. I play guitar. I've been playing what? My mom's over there, actually. What age did I start playing? 8 years old? I think it was 8 or 9.
We'll take
8 or
that.
9 years old, I started playing guitar. And I'm trying to start a band in Kentucky. But look, I think we talk about all the systematic things. People don't take a look back throughout history. And they don't take a look at how the actual structure of the system works. And I think Welcome the Machine, when every time I hear that song, it's like we are all living in this machine. We need to understand how the machine works to put the parts and pieces together to understand our money. I don't think enough people think that way, whether it's going to college, debt issues, things like that. I think it's all things we need to think about.
Are you an optimist or a pessimist on the future?
I'm a pessimist at heart, which is kind of hard because optimists make money.
I would
I
say
convince myself.
you kind of come off as an optimist.
Well, I convince myself to be an optimist. So I'm a pessimist at heart, but I convince myself to be an optimist. And I think that's a dangerous combination because if you are at least aware of the risk as a portfolio manager, advisor, but you also convince yourself to be optimistic in areas that maybe you think there's going to be money flow, I think that's where you make money.
Okay, so you're a pessimist, but you did start your own business, which I feel like you sort of have to be an optimist to believe in yourself. You're the president and CEO of Lloyd Financial Group. You started this company a few months ago. Yep. Tell us a little bit about what made you decide to go out on your own.
There's so many factors. The biggest one being that I made a lot of life changes the past couple of years, meaning that I got married in November. So that was kind of a big self-reflection on what I wanted out of life. I think I'm planning on having kids. No news yet, but I'm thinking about having kids maybe the next year or two. So going through all of that thinking, I'm like, you know what? If I don't do something now, and when I'm 60 or 70 years old, really look into my future, am I going to regret not trying to take a risk and trying to change the world in some sort of way? And what I mean change the world, I'm saying actually impact people's lives in the vision that I see, right? So the legacy, the purpose, I think a lot of people don't have a lot of purpose in today's world. For this was something I needed to do, not for any monetary gain, not for monetary reasons. That's the goal is to make other people money, to make me money. But
it is finance.
This is a game. It's fun. Business is a big game, and I enjoy chess. That's another thing we didn't talk about. I enjoy chess. And
the
I
4D kind.
Yeah.
30, There are just 30 seconds left. Hardest part about starting a business?
The regulation. No, this industry, even doing this right now.
Another 23 minutes we could do on this, I'm sure.
Exactly. So regulation.
All right.
And the insanity of thinking about how to build it and put it together.
All right. Excellent. Luke Lloyd, I wish you the best on your business, Lloyd Financial Group. And we're winding things down here at Stocks in Translation, but make sure to check out all our other episodes of our video podcast on the Yahoo Finance site and mobile app. We're also on all your favorite podcast platforms, so be sure to like, leave a comment, and subscribe wherever you get your podcast. We'll see you next time on Stocks in Translation.